Hello everyone, welcome back to Fundrise Finance. The markets this week proved again that it likes more clarity than uncertainty. After months of uncertainty and many assumptions, the Federal Reserve finally increased its rate hike this week. At least we now know what the Federal Reserve will do this year and the next over the rate hike. And we see that rewarded in the market's performance this week, which is up almost 6% since the rates were announced. It has been a long time since we have seen 3 days of back to back gains in the market. But are we out of the woods yet? I don't think so. The inflation is still very high at record levels. And we see that reflecting in almost everything that we use in our day to day lives, with the prices that we pay for the gas at the pump being the largest culprit. And with the Russia Ukraine war seeing no signs of going down, the gas prices will stay high for a while now. The rising fuel prices will have an impact across the board. In a research from JP Morgan and Chase, when consumers are able to save money at the pump, spend that in different areas like service industries that include restaurants, entertainment industry, non-durable goods like groceries, retail, and department stores, and durable goods sectors, which includes electronics and appliances. In the current situation that we are in, the rising fuel prices does not give consumers this freedom to spend on different areas. So when different sectors of the market do not get the spending that they need, they contract. And when that happens, we usually get to hear the term called recession. So it will be a long time before we can say that we are in a safe position. But until then, in these times of uncertainty, dividend stocks give relief to an investor. I consider dividend stocks to be the best mode of investment. And if chosen wisely, they offer good rewards. In this video, we'll discuss about a few such dividend stocks which increase their dividends. So we will see if it's a wise choice to invest into these in the current market situation. If you are new here, consider subscribing and hitting that bell so that you don't miss a single video packed with valuable information just like this one. The first company on our list is Dollar General, ticker symbol DG. Dollar General is a chain of stores that sells variety of items at a very low price. With the inflation at a 40-year high, consumers are trying to buy their day-to-day items at a low price within budget. And stores like Dollar General help in this purpose. And that resulted in the strong sales in the store. In its recent results, Dollar General gave a strong forecast for 2022 under the hopes that inflation will drive more and more customers to its stores. On top of that, Dollar General also announced a massive dividend increase of 33%. Dollar General offers a low yield of 0.79%, but that grows at a very good rate of almost 11%, which is more than the current inflation of 7.95%. It has a very good payout ratio, just under 16%, which means it has enough cash reserves in hand to combat the inflationary prices and also continue to pay dividends. When we look at the performance of Dollar General year to date, it has given minus 5.75% in the last year, just over 18%, and more than 200% in the last 5 years. Looking at the financials, we see the revenues are on a nice upward trend. Also, the profit, when the operating income is holding up nicely, and when you see the dividend per share, even that is growing regularly. Looking at the free cash flow, even that we see a good uptrend. Track your dividends gives Dollar General a score of 71. Overall, Dollar General is a decent investment that offers a low yield but at a high growth rate. This investment makes more sense in the current high inflationary environment we are in, where stores like Dollar General turn from a consumer discretionary into a consumer staple category, where consumer can buy the things that they need in the budget they can allocate. The next stock on our list is Williams Sonoma Inc., ticker symbol WSM. Williams Sonoma is a consumer retail store that sells kitchenware and home furnishings. It is one of the largest e-commerce retailers in the US. Williams Sonoma announced a 10% hike in their quarterly dividend, which is good as it bumps up the forward yield to more than 2%, which is well above the broad market average. Year to date, Williams Sonoma has given minus 5%. In the last 1 year, almost 18%. And in the last 5 years, it has given almost 224%. It has a very good 5 year growth rate of almost 12%, which is well above the current inflation. And the dividends have been growing for the last 12 years. Looking at the financials of the company, we see the gross profit in an upward trend. Likewise, the operating income as well as the net income, which is good. Even the dividends per share is on a good upward trend. Even the cash flow seems good. Track your dividends gives Williams Sonoma a score of 70. Overall, Williams Sonoma also sounds a good investment, offering a good yield that is increasing at a good rate. If you like this video so far, I would really appreciate if you could hit on that like and subscribe buttons so that YouTube can recommend this video to many more people. The next stock on our list is Realty Income Corp, ticker symbol O. Realty Income is a real estate investment trust that invests in single tenant commercial properties and leases it out to retailers like Walgreens, Dollar General, Ulta Beauty, etc. It is a very well-known stock in the dividend investor community that is known for paying its dividends every month. Realty Income announced a dividend hike of 0.2% recently, which may not sound really high, but Realty Income actually raises its dividend every few quarters. So when you look at a yearly perspective, the dividend hike is much more than 0.2%. Overall, Realty Income has a forward yield of 4.52% that does grow at a fairly low rate of 3.63%. So Realty Income is geared towards a portfolio which looks for a stable generating income every month. It is a dividend aristocrat, which means it is part of the S&P 500 and has been paying dividends for 25 years or more. Year to date, Realty Income has fallen almost 7%, and in the last 1 year, it has given 4% returns. As I was mentioning earlier, here we can see the dividend payouts increasing every few quarters. Usually, Realty Income trades in the low to mid 70s, and with the recent dip that we have seen year to date, it is at a very good buy point, and one should make use of it. The last company on our list is Signet Jewelers, ticker symbol SIG. Signet Jewelers is the world's largest retailer of diamond jewelry. It operates stores such as K Jewelers, Zales, and Jared. Signet Jewelers just announced a dividend raise of 11% and also gave a very good forecast for the upcoming year. With more people coming out of the pandemic situation, thereby more and more weddings being planned, Signet Jewelers sees a very nice uptick in its sales. But is it a good investment? Year to date, it has fallen almost 11%. In the last 1 year, it has given a good 40% return. It has a very low yield of 0.69% with a negative growth rate of minus 12.3%. It has no dividend growth because Signet Jewelers had cancelled its dividend in 2020 because of the pandemic situation. Looking at the financials, the profits are at a downward trend when the operating income doesn't look good. The dividend per share, as we see here, does not have anything in 2021. And when you look at the cash flow, it's very erratic. Overall, Signet Jewelers is not a good dividend stock to hold. We need to see how they bounce back from the pandemic, how the sales are in the near future, and how is that translating into profits and cash flows. So we should steer away from it at the moment. So these are the four companies that we just discussed. I hope you like this video and the information has been valuable. Till we meet in the next video, let's try as much as we can to be financially healthy. See ya. Bye.